Hello everybody. In this video I'm going to do double declining depreciation and show you how it works. So the question is, on July 1st 2014, the Callao Corporation has purchased a computer system for $50,000. The accounting department says that there will be 8 years of useful life on the asset, and the asset will be worth $1,000 at that time. The Callao Corporation's fiscal year ends January 31st. Use the data to produce a quarterly double declining depreciation schedule using the following methods. So I'm going to show you what their journal entry is going to be: their initial journal entry, their regular journal entry, and their ending journal entry. So let's start with that. So we're doing double declining. So the first thing you want to do, write down our information. So the cost of the asset is $50,000. They have an useful life. Let's go useful life of 8 years. And they have a salvage value of $1,000. And it was purchased July 1, 2014. And their fiscal year ends January 31st. Okay. So now with that information, how you find double declining depreciation, you're going to take 100% and divide it by the number of periods that you're going to have the asset. Now here we have an 8-year useful life, but we're going to do this quarterly. So we're looking at 32 periods. So what we're going to do, we're going to take that 100% divided by the 32 periods, and we're going to get 3.125. Now that's the straight line number. So I'm going to put straight line. In order to get double declining, we're going to double that or multiply it by 2, right? So if we multiply that by 2, we're going to get 6.25. And this is the double declining number. So what does that 6.25 mean? What it means, if you see here, the fiscal year ends on January 31st. That means that it begins February 1st. So if I draw a line that showed the fiscal period, the first fiscal period will be February 1. The first quarter will be February 1 to May 1st. The second quarter will be May 1st to August 1st. And then the third quarter will be August 1st to November 1st. And then the fourth quarter will be November 1st back to February 1st. Okay, so with that in mind, when they made this purchase on July 1st, that only gave them 1 month of time in that second quarter. So if you think of the quarters, it's first quarter, second quarter, third quarter, fourth quarter. So with that in mind, we need to, is that we're going to take the cost. The cost is $50,000 and multiply it by 6.25%, which that is 0.0625, and you will get $3,125. And that will be that will start our first depreciation expense. However, I want to go back to something that I said on the first slide. Only use 1/3, right? So we only have 1 month out of the 3 months. Or maybe I should say 1 month out of the 3 months that we own the property in that quarter. So we need to take 1/3 of the 3,125 multiplied by 1/3, and we'd get $1,041.67. So therefore, our first journal entry at the end of July, actually it'll be July 31st, to represent that first quarter it was purchased, will be depreciation expense, debit of $1,041.67, and accumulated depreciation, credit of $1,041.67. And please don't forget, accumulated depreciation is a contra asset account. All right. So that's the first, that's the July 31st transaction. If you see here, our depreciable value at that time was $50,000. We depreciated $1,041.67 off of the asset. What happens at the end of the next quarter? So at the end of the next quarter, which would be October 31st. So let's put October 31st here. We have to do another calculation. Now, let's go back to that last slide. So if we were to do the math on that, so that would be 50,000 minus the $1,041.67 of depreciation for the first quarter of the life of the asset, we would have $48,958.33 that needs to be depreciated. That is depreciable value remaining on the asset. Now, with double declining, what you do is take the remaining depreciable value, multiply by the double declining factor, which would be 6.25% in this case, and you would get a depreciation expense of $3,059.90. And so, therefore, for October 31st, your depreciation expense would be a debit of $3,059.90, and your accumulated depreciation, I'm going to use some abbreviations here, will be a credit for $3,059.90. All right. So I'm going to do one more quarter. So this would be, to make sure this is understood. So in the next quarter, at the end of the next quarter, you would have you would have the remainder of $48,958.33 minus the $3,059.90. So that would equal $45,898.43. So this is what you would start off with on January 31st is the remaining depreciation. And you would take that number and multiply it by 6.25%, and you would get $2,868.65. And this is the amount you would debit depreciation expense for, and credit accumulated depreciation. So what you would do is, in that last quarter, that will be July 31st of 2022, you would debit your depreciation expense for the amount of $5,621.20, and credit accumulated depreciation $5,621.20. How you get $5,621.20 would be the $275.91 of what you calculated for the depreciation expense, plus the $5,345.29 remaining in the depreciation. And that way, when you did this depreciation, or this journal entry, you would bring the assets book value, so let's just call it equipment. Once you did that debit, you will bring the equipment's value to $1,000 with that. And so that's how you would do double declining. I hope this helps. Have a great day. Now, lastly here, I want to show you what a depreciation schedule would look like once it was completed. So this is on a quarterly level. So as you see, these periods here are by quarter. They're by the quarter. And then you have the depreciation value. You take that depreciation value, multiply it by the rate to get the depreciation expense. And then you take the prior year accumulated depreciation plus the current year, and you would get the current year depreciation expense to get the accumulated depreciation. And then in order to get the remaining book value, you would take the prior year book value and subtract that to the depreciation expense. Now, I'm showing you this because I want to show you what happens in the last quarter. So this is a quarterly rate. So if you see in the last quarter here, we multiply, because in the first quarter, we used a 1 month depreciation expense, or a mid-quarter. So in the last period, we use the last 2 months. So if we did this calculation, what happens is we have a remaining book value, if you kind of see here, of $6,345.29. Now remember, our salvage value is $1,000. And so therefore we're about $5,345.29 short of that when it comes to the last quarter. So what would you do?